Welcome, everyone. This is the September of 2024 webinar from Principal Wealth. I'm Julina Ogilvie, partner and wealth advisor with the firm, joined, as always, with Bob Paolucci, our founder and CEO. Bob, welcome.
Welcome back, Julina.
Yes, it was a great summer, and now we are pivoting into the fall. And the title of this webinar is The Dovish Pivot. And as always, we have in the cadence of this presentation, three key areas that we want to talk about. We want to talk about the markets, we want to talk about the economy and policy, and we want to talk about everything else. And Bob, I don't know if you want to run through some of these or if you want to just get right at it.
We'll get right at it. We have a lot to talk about, a lot of good stuff, some pending decisions, but it will all be good stuff down the road, and we will show you why.
Yeah, we have discussed in past webinars that there are some pivotal decisions that need to be made as we enter the end of this year. There's a couple that are still out there, so we want to make sure we hit those in today's conversation.
Yeah, let's start with the markets.
Let's start with the markets.
So we're in the softer months of the market, which I always define as August through October. And you can see it on this chart if you look at it. So this is actually interesting. It's broken out between non-presidential election year. This is the S&P 500 going back 50 years about, and presidential election year. And presidential election years, just because of the amount of nonsense and noise that occurs, they tend to be more volatile. And like clockwork, we've had some volatility. But you could see right around the August-September line, the market sort of goes sideways and starts to arc up and down, but mostly a little down from the September-October period. And then it starts to catapult up sometime around November. We're just going to say post-election and through December. That is actually a very, very consistent pattern. We see it often. This is what we do for a living. And we have no reason to believe that the same will happen. So what does that mean? We'll probably have some turbulence for the next 60 days or so, followed by some relief after that. Fundamentally, what's going on? Nothing. We're just getting closer to election time. You also have these other things that actually matter, like big institutional investors are closing their books for the year. They're trying to lock in gains for the year. They might not invest as much money for the next couple of months. You have mutual funds who are trying to calculate dividend distributions, capital gain distributions, and they're trying to get them paid out pretty soon. So what do? Well, if they don't have enough cash to make the distributions, they have to sell securities. They have to balance their gains and losses. So you have a lot of activity, but there's a lot of freeing up of capital that happens over the next 60 days. So it just so happens that it's correlated to the same time frame as the election cycle, and it is what it is. So nothing to fear other than a little bit of turbulence, but don't worry. That tends to self-correct itself and create an opportunity for investment, and hence the market rises towards the end of the year. So very consistent chart, something to be mindful of. So when you see some volatility, understand it's volatility for the sake of volatility. There's not that much more to it.
Yeah. Key point is, regardless of the outcome of the election, once that occurs, the markets look forward and they tend to go higher.
Mm-hmm.
And so speaking of higher, we talk a lot about the markets hitting all-time highs, and I think this is a really interesting slide to address that.
Yeah, higher and higher and higher historically. So you actually want to invest in all-time highs. It tends to be the most significant trend when you look at where markets are, whether they're at all-time highs or not over time. And then you measure all periods together. So when you look out 1 year, 3 year annualized, 5 year annualized, shockingly, and I know this comes as a surprise to probably everybody that is looking at this, investing at all-time highs, they tend to compound.
Yes.
You rarely see the lonely week where we hit an all-time high out of nowhere and then it just stops. There's a reason why we hit all-time highs. It tends to be a compounding of positive forces that last for quite some time. So you want to invest in the train that is all-time highs rolling higher. Mm-hmm. It tends to be the most powerful trend looking back over time.
We say this all the time. We live in a market of all-time highs.
That's right.
Yep.
That's right. I always remember you saying that.
Yeah.
Yep.
I'll take credit for it. Thank you.
Absolutely. I've only heard it from you. So
Yeah. And let's talk about the Magnificent Seven because we've talked so much about how much the return has been concentrated amongst these seven, but it's interesting to look at the trends going forward.
yeah, there are a whole bunch of slides we're going to put in to emphasize this, but there's more to the market than just the top seven stocks. Nvidia, Amazon, Apple, Microsoft, so on and so forth. So what you see here is a tremendous amount of earnings growth in 2023 relative to the rest of the S&P and small caps. But then 2024 estimates, you see an amazing amount of earnings growth for the Mag 7, the top seven. But then you see a rise, a pretty big relative change in the rest of the S&P, which is very good for their earnings. And then a huge change, huge shift in small caps. And then you look in the out year, you go to 2025, and the estimates are, yeah, there's still projected earnings growth in the top seven in the S&P, but look at the huge rise, the relative huge rise for the S&P 493, which is the rest of the market. And then what a massive shift in the earnings expectations for small cap from negative 12% in 23 actual to a 30% increase. That's a titanic shift there.
Yeah,
And it just tells you that there's opportunity outside of just the top seven, which is why we have exposure to this stuff,
absolutely.
because there's huge opportunities
Yeah.
that are out there.
And I would say not only have we been looking at these opportunities and talking about them, but as we approach year end too, in the opportunities in rebalancing portfolios as well.
Yeah, and this is helps with the breadth and depth of the market.
Yeah.
This is a deeper market, a more resilient market, a more full participation market, and that's what you want.
Mhm.
That is a sign of a very, very, very healthy market, and we are starting to see that.
That's great. And I think the next slide might surprise people because when you're in a return of double digits for the year, people assume that the markets are really expensive. And then this slide addresses where the markets are from a cheap relative to expensive valuation.
Yeah, so this is measuring the average stock, right? So not just the top seven of the S&P 500. This is the
Great
equal
point.
weight index, right?
Yep.
So this is the 500 equal weighted. So Apple and Microsoft and Nvidia don't have a huge percentage advantage with their weight. It's all equal weighted. And when you measure the equal weight index, the historical price to earnings ratio is at its historical average. That's not expensive.
Right.
That is not expensive. So what does that tell you? Well, it tells you that the rest of the market is cheap, and it's really the top seven that are expensive. But they're expensive for a reason. They're the highest quality companies with the largest cash balance, no need to borrow. They grow their earnings pretty significantly, and they are considered the safety companies, right?
Yeah.
We're not saying that. We're just telling you that they are considered the safest companies. We believe that to some degree, but we also believe that there's opportunity elsewhere. So when you measure the average stock, we're at fair value.
Hmm.
Things aren't out of control. And, this fair value, PE might go down because earnings expectations are
Going higher.
headed much higher. So this will actually make stocks a little cheaper, assuming price doesn't move up beyond the
Right.
earning growth rate. So we shall see in coming quarters, but we are we are not worried about the market being completely out of line here.
No, absolutely. And if you want to talk about an asset class that's cheap,
Yeah, interesting chart. So smaller and cheaper. So small caps relative to large caps, uh, the relative price to earnings ratio, it's way out of control. It's really a three standard deviation move. So 98-ish% of the time, you don't see this. Small caps are very cheap. They trade at a significantly lower price to earnings ratio relative to large caps. And to us, we love investing at extremes, right? Usually negatives, because there's a lot of good stuff that's been thrown out or not invested in, where we find lots of opportunity. And we've talked about this for a while now. We've been nibbling at small caps for some time, and we think there is a great opportunity in the coming years, price wise, to play out. So you want to invest when things are this cheap on a relative basis. I can argue that they've never been cheaper relative to large caps. Good time to put some money in small caps.
Yeah, and one point I would make about this slide, it's interesting to watch the drop in the valuation going through the pandemic, which made sense. There was a recovery, and then when we started raising rates aggressively, you could see the fall there as well. So if there's a correlation, you think about rates going forward, which we've discussed, there's some of the opportunity.
You're absolutely right. It was small caps remained cheap, or actually got a little cheaper relative to large caps. But really, this go round because of the rapid rise in interest rates, and higher interest rates hurt smaller caps more than they hurt large caps. So you're absolutely right.
Great. And so let's talk about dividends and buybacks because we always address the fact that they're so great for the fundamentals.
Yeah. So if you ever want to, if you ever are worried about the fundamentals of the companies in the market, there are plenty of things to look at. One thing that we look at is the direction of buybacks, companies buying back their own stock. Keep in mind, they have to use their own cash to buy back their own stock. Number one. Number two, companies that pay dividends. So when you see rising buybacks, really amongst large cap, mid cap, small cap, and a rising number of companies that pay dividends amongst large, mid, and small caps, that's a good thing. That's actually a very good thing. Companies are not going to dish out their cash that they have on hand to shareholders unless they can. They really want to hold on to that cash to acquire a company, to start a new line of business, to put it, into their business, to hire more people, to create a new product, so on and so forth. So when they have an abundance of cash and they're spending it on buybacks and dividends, that's a healthy company. That's a very healthy sign. Now, on the flip side, when you see those lines go down pretty significantly, that is not a good sign. And what we see here is health. And the reason why we talk about these two components is they are a pretty big component of total return. And that we'll show you this on the next slide.
Yeah.
So when you look at the price of securities, what makes them move, right? So many things, but some of the core elements are dividends, buybacks. So you own a security. Are you getting a dividend? Okay, well that's contributing to the return, right? Is the company buying back shares? Sure. It's reducing some of the outstanding shares, therefore yours become more valuable. How about earnings? Yeah, earnings tend to be the biggest weight in total return. And then PE multiple, what does that mean? That means, are people willing to pay a premium for the company or not?
Mm-hmm.
And what you see looking at 23 into 24 is the biggest component of total return is earnings growth. So earnings are actually moving up,
Yep.
and buybacks.
Yes.
And then you have dividends in red. And, ironically, it's the paying a premium or not. So, sort of the hype, that is a pretty small component, actually
Yeah.
smaller than dividends. You wouldn't think that because of all the hype around AI and these other themes. But this is a fundamentally driven market, backed up by buybacks, earnings, and dividends. How about dividend increases? We didn't even talk about that.
No.
So this is the decomposition of total returns explained. This defines the movement of securities. It's all here.
It's all here. I think this is one of my favorite slides for this month because we've talked so much in the past about earnings and dividends and buybacks, but we've never been able to really show it together in
Mhm.
terms of how it makes the return of the market. So I don't know if you found this or Kyle, but kudos. So,
Mhm. It's a good one.
and then let's talk about lower rates and the impact on the stock and bond market.
Yeah. So historically, when rates are cut, this is monetary policy. It creates higher asset prices. So on the left side, you have the S&P 500, so stocks, U.S. stocks, and on the right side, you have bonds represented by the 10-year Treasury. So this really charts out a year before the last rate hike and then 24 months after that, right? Which oftentimes gives you rate cuts. And what you see is higher prices in bonds and higher prices in stocks. There are really good reasons to be optimistic here. The one outlier on the left is the tech bubble implosion. Nothing could help the overvalued market in 98, 99, and 2000.
Yes.
So, lower rates didn't help because why? Well, there were no earnings backing the value of the NASDAQ at that time.
Mm-hmm.
So that was the one outlier, and we are certainly not there. So historically, lower rates over short and long periods of time create higher capital market values. And we don't think this time will be any different.
I would just add one point to these slides. I mean, historically, it shows us over the next 2 years, the positive return that you get both in stock and bonds. But even on the right-hand side, where you look at the clump of bond returns, you're looking at close to a 20% return in 2 years, right? That's a return that you get in the stock market, not the bond market. And we've talked about this before, but I think it's a great visual of those numbers.
Yeah. I mean, I can get granular with this. Why is the cluster so tight on the bond side? Because it's just math.
It's math.
There's
Yeah.
not a lot of emotion with this. It's just math. And we talk about this a lot with our clients.
Yeah.
On the left side, it's a combination of things. It's hype, it's mania, it's greed, it's all sorts of stuff, but it's all generally good. On the right, it's just math, no emotion.
Yeah. No, I love
So,
I love that point. Thank you.
yep.
And specific to the bond market, let's talk about municipal bonds, which we
Yeah.
haven't really done so in a while.
Yeah, big opportunity. We were talking about this, Julina, before the call, but really a big opportunity in municipal bonds. So for those listening, worrying about lower rates, we've been investing pretty heavily in treasuries over the past 18 months or so for our clients. We've slowed that a little bit. We think that opportunity is just about done, and certainly will be as the Fed cuts rates. Are there other rates out there? Oh boy, yes, there are. And there's a different yield curve in municipal bonds. There's quite a big opportunity in municipal bonds to get clients in their non-retirement accounts a bunch of tax-free income. It's a very attractive time for municipal bonds. I don't think that is going to change anytime soon. So worry not. We will find yields in other places. We just point out that, if you look at this chart, let's say you pay 50% in tax. We'll just keep the math easy. The tax equivalent yields in municipals far exceed the treasury yield curve. And this is stale. The treasury yield curve is even lower. So munis look even better relative to treasuries. So what does that mean? Well, that means clients, if you're listening, you own more municipal bonds than you have, and you'll own even more in the future because there's quite an opportunity there to replace the high yielding treasuries with net higher yielding municipal bonds for you now and very likely in the future. So worry not.
And not only worry not, but a lot of the concern around municipalities coming out of the pandemic, when you look at the far right-hand side, you can see how healthy the debt is on a state and local level relative to the federal level. It's a bad comparison, but
It's an interesting
it's
comparison, but
it's
you're
pretty
right.
obvious. And then on the bottom right, the default rates are also much lower. So
Absolutely. Yeah, it wouldn't compare to corporates, but you're right. On the top right-hand chart, that's what Julina is referring to. You have debt as a percentage of GDP, and you see municipalities or state and muni debt is at 13.1%. Government is at 97.6, but we won't talk about that. But yes, relatively speaking, states, municipalities
yeah,
pretty good.
look pretty good. Yeah.
Pretty good. Yeah.
So I would say really quick to summarize from a market perspective, there's some great opportunity, some good fundamentals. And so let's now transition over to the economy and policy.
Yeah, fun. So Franklin Templeton puts this checklist together. They do a good job of it. They list out uh, many of the subcomponents through their lens that define whether or not we're in a recession, going into one, coming out of one, so on and so forth. And they do this great job of putting it out there quarterly. And what you see here is the trend, which starts on the far right and then moves left, is the trend in December 2023. There wasn't any green. Same for March of 24, actually. There was just a lot of caution and a lot of red X's. Today, we have a combination of all three. We have some expansionary data. We have some cautionary data. We have a little bit of recessionary data. But again, take this with a grain of salt. Things can have change quickly. Things can go red quickly. Things can go green quickly. Rarely do you ever have all green. I believe you'll see more red than you will see all green quickly. Part of that is because of the measurement period. A lot of these data points are stale. So take it with a grain of salt. But according to their chart, overall signal is green arrow up or thumbs up. So if a recession's coming, they don't see it.
Yeah, I think
And,
it's a
and
great.
nor do we. We have some interesting data. Again, we've talked about this in the past. Julina, we were talking about, we believe that there was a recession in the first and second quarter of 2022. You had two consecutive quarters of negative GDP growth, which 99.9% of the time means you're in a recession. It just wasn't called because the unemployment level wasn't there. The unemployment level wasn't there is because we were coming out of the pandemic. But we did have a bear market, which is kind of tied to a recession, right?
Yeah.
So we believe 2022, we had an uncalled recession because we really did have alignment of the data. I don't think we're going to have one. Things can change, but you have a Fed who's moving into a position of cutting rates to provide stimulus. Usually that counteracts recessionary trends.
Yeah.
More to
And
come, but we don't think we will be in a recession.
no, and I think the one observation I would make from looking at these a slide like this for decades is you want to really just look at the trend, going from the right to the left. And if you're looking for the constant green arrow going up, you're going to be constantly bearish to the economy. You're never really going to find it. So
Yeah.
we got to look at the trend, if that's
Right.
fair.
Yep.
Yep. So we have to talk about the Fed because we're addressing them in the title of our webinar. And let's start with Jackson Hole.
Yeah, the dovish pivot. So, like clockwork, the Fed at their vacation meeting, which is in Jackson Hole, they typically use that meeting to change direction, change the tune, change the tone, plant some new policy, and they did. So, Jerome Powell's words, the time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on the incoming data, the evolving outlook, balance of risk, the weather, and great. So that means rate cuts are coming this month. Now the question is, will he start with a quarter or a half, which would be two, or will he save that half for November? Who knows? But the Fed's cutting rates. The market forecast is the Fed will cut four times this year by 100 basis points. Sounds about right. But the forecast, again, is if you pick a line on this chart by next year, that rates will come down by anywhere from 150 to 250 basis points. If you split the difference, there you go. There's your number. I think both are justified. I think more could be justified. We just have to get from a high level of rates, a relatively high level of rates, 15 years at zero, followed by 2 years at five and a quarter.
Mhm.
Feels like 50% rates, but it's only five and a quarter. Somewhere in the threes is appropriate. So let's get there as soon as we can and live there and not make promises to go lower. We'll see what happens.
Going
Rates are
forward.
coming down. Finance costs is going to come down for most people, many businesses, all that fun stuff. It's coming finally. They have gotten with the program. We will get action from them this month. Not in October. There is no meeting. Then again in November. Then again in December, and probably quarterly thereafter. But
We're
we'll cover
we're
that
we're
when we get
finally
there.
there.
We're there.
We're there. Okay. And Bob, in all of my career, I've never addressed an economic slide titled Poof, but here we are.
Well, in my career, I've never seen anything like this.
Yeah.
So, there's so much weight that the media puts on these economic reports. Why, I don't know, because every single one gets adjusted. If it's too good, it gets adjusted. If it's too bad, it gets adjusted.
Mhm.
Um, Last month, 2.5 weeks ago, we got a revision to the payrolls number of minus 818,000. I just don't know how you could be that wrong. We were joking. Do they need a new calculator? Did the abacus break? What happened? Were they not paying attention? Were they watching too much reality television? We have no idea. But all the excitement around an increase in payroll statistics, which is the equivalent of jobs, was removed.
Mhm.
So it's as if no jobs were created this year. Hence, the unemployment level has risen.
Right.
So take the jobs information with a grain of salt. It gets revised, usually, let's see, quarterly, semi-annually, and annually. And the annual one, they make revisions to all the months. So that's why there are multiple revisions. So don't pay too much attention and don't overweigh the impact of the economic data because it's stale. Not only is it stale, it'll get revised two or three times, but the market moves on it. It is what it is. So just so you see this, a lot of the hype around jobs created, job growth, payroll, equivalent increases, the air has come out of that balloon just about completely.
Yep.
So
And another hype that we have to talk about is inflation.
inflation deflated.
Yep.
This is an interesting chart, very different way to see it. This is a 3-year U.S. Treasury inflation break even. Long story short, this is the market expectation 3 years out as bet on by the bond market. And boy, is this one accurate. They have inflation 3 years forward in the ones. And that feels about right
And Bob, why do you say this is accurate?
because it has been quite accurate and money is put on the table for the
Mhm.
direction of this. And the money isn't wildly wrong.
Got it. Yep.
Yep.
Thank you for saying that.
Yep.
And what about housing?
Oh, what about it? There are no listings, therefore there are no home sales. Why? Well, interesting, you have high demand. Prices are relatively high. Interest rates are high. That's the kicker. The quality of homes that are out there are low. Everything needs a renovation that's listed right now. It's the least desirable stuff. The stuff that's desirable still sells in a weekend, if not same day. The real driver here is affordability, right? You have sellers, not probably our clients, but the average individual who wants to or needs to sell a house. They are waiting. They're waiting because the house that they're going to get into is going to be coming with a higher mortgage rate than they have right now.
Yeah.
So, most people move up in life when they, move into homes, better quality homes, regardless of size. And you have a weird scenario where downsizing or moving means you might buy the same value house, you might buy a slightly more expensive house, but we've had a low rate environment that we're coming out of for 15 years. It really didn't mean higher payment. Well, now it means exponentially higher payment. Whether you're buying a better house, a smaller house, a condo,
Yeah.
finance cost has risen exponentially. And it is forcing sellers to wait, and it's also forcing buyers to wait. I know a lot of people who are waiting until rates come down to buy something who are renting, rightfully so. And it's coming, and we'll probably see this chart, which looks horrendous because there's no inventory. Because there's no inventory, there are no home sales. That will probably change dramatically this spring housing season.
Okay.
So your realtor will be very busy come this spring season because mortgage rates right now are at a 52-week low. And remember, there's no impact to this chart because it takes 60 days, 90 days to get a housing transaction
Not
done.
overnight.
Yeah, so it's not overnight. So there's a lag. But with the decrease in mortgage rates, decrease in long-term rates, and the decrease in short-term rates, even, that is going to create a wave of opportunity, a wave of transactions in housing in the coming months and quarters. And there is pent-up demand probably to last a couple of years. So we're going to see a lot of activity. So what does that mean? Well, you might want to go open a self-storage business or a moving company because there's going to be a lot of opportunity out there. To make this point a little clearer,
Yeah.
we've titled this one Make Room in the Basement. What is this chart? Well, this chart is affordability, U.S. housing affordability. And left side is good, right side is bad. In particular, the upper right side is horrible. What is that quadrant? That quadrant is high down payments and high monthly payments. So in English, you have to put a pretty significant down payment post financial crisis, 20%, sometimes more depending on the product. And you have a high monthly payment. Why? Well, mostly driven through finance charge,
Yeah.
right?
Yeah.
So that has directly contributed to why there are no transactions. Housing is incredibly expensive, but it shockingly has not created a low demand.
Right.
It has created a pause.
Right.
And the pause is rates have to come down, right? Yes, they're coming down. So it's just created this delay, which will create really probably a boom, an activity boom, not a price boom, an activity boom in the coming quarters. So this proves it here. Housing affordability is, according to this chart, as high as it's ever been, at least going back to 1970, the early 70s.
Yeah, it's a
So
very
not ever,
disturbing chart.
but a generation and a half high.
Yeah. But to your
There you go.
point, we believe that it will improve, and when you look at the estimate, it's already starting to move. And so, but again, it's still disappointing to anyone trying to buy a home.
Yeah,
So,
make room in your basement, Julina.
yeah, I don't have a basement.
Let's build one.
There you go. So before we finish the economy and policy, let's talk about the consumer.
Yeah, breakdown of the consumer. So this is consumer by income level. And really the consumer broken out into five categories here: bottom quintile, second, third, fourth, and fifth.
Mhm.
You can see that the first three quintiles, the lowest income consumers, the first three total 39%, which is the same as the spending and economic effect of the top quintile.
Mhm.
So what does that mean? Well, we need a scenario where we don't tax the wealthy people so they can continue to consume because they consume a lot, and they move the economy higher. And we need a scenario where there's not an uncomfortable amount of inflation for the bottom three.
Yeah. And
Um,
Bob, sorry, you say that because our economy, our GDP is 80% driven by consumers.
ish. Yeah,
Yes,
consumer
ish, yes.
spending plus government spending, all that. Yeah, you
Yeah.
can get there. But yeah, it's our economy is consumer driven,
Hmm.
right?
Yep.
We are not an export based economy. We are a U.S. consumption,
Hmm.
the people here consuming stuff based economy. And when you have things like outrageous inflation and or outrageous tax policy, you should expect less economic growth. Period. End of story.
Yep. And I think just to do a little bit of a deeper dive on the consumer right now.
Yeah. So this is an interesting chart. I think a lot of people will stare at this and find it helpful. Paints an interesting picture. So this is as of September 1st or August 31st.
August 31st. Yep.
Yeah, this is total assets, total consumer assets made up by deposits, other assets like watches and cars, pension funds, other financial assets, stocks and bonds, and all that fun stuff. Um, a nice balance sheet of the consumer and liabilities, just right of that. So there's quite a spread between assets and liabilities. So we're all in better financial shape than we're making it out to be.
Hmm.
Then on the top right hand side, this is probably one of the more important ones. So when you hear the threatening or alarming headlines about debt rising at the consumer level, it's all
Yes.
relative, right? We're coming off of the lowest debt to income ratio in history over the past, you go back to like 2018, 19, 20. Yes, the debt to income ratio has risen, but it still hasn't risen to a normal level yet. So net financials are still very good for consumers. On the bottom right, you see flows into early delinquencies, and this kind of tells you that there's really two consumers: those that need to borrow and those that borrow. The need to borrow individuals are feeling the pinch. Why? Well, if you bought a Kia 6 years ago, you financed the $40,000 Kia at zero, and your payment was $300 a month. You finance the $40,000 Kia a year ago, you're
Hmm.
paying $900 a month for the same car. So what you're seeing here is auto loans and credit cards, the delinquency has risen. Why? Well, mostly due to the compounding, now much higher interest expense, right?
Yeah.
So in some cases, you don't have to spend more money. You just have to have credit at a higher rate,
Yeah.
which creates difficulty,
Hmm.
right? Creates a much higher payment and a much higher and sometimes growing level of debt. Again, those who need to borrow and those who borrow. I guess there are three consumers: those who never borrow,
Right.
right? And we won't address student loans um, because I don't think we should.
Okay.
All right, next slide.
Yeah. And so this is one of my all-time favorites, but we talk a lot about the cash on the sidelines, but it's been a little while and it continues to rise.
This is like Magic Mountain. So this chart creates a bull market.
Yeah.
So whenever you have this much cash on the sidelines, whenever you have these big peaks, get invested, because as this money comes down off the mountain, it goes back into where it came from, the capital markets. the bond market and the stock market. This abundance of cash will reintroduce itself to the capital markets as rates come down. Why? Well, a 5% money market is great, but you can't marry it. It goes away quickly. So what happens? Well, that money ends up finding a better home. Unfortunately, it doesn't happen quickly. So there's a lot of opportunity cost lost as it slowly comes back into the market. It all should have come back in January of 23, but it didn't because that's just human behavior and investor behavior. So this is the great enabler of bull markets. And boy, oh boy, we should have a pretty good bull market because of this chart right here.
Yeah. We talked about this last summer and we were shocked as to how high this level had come, and yet it has gone even higher. So again, that opportunity going forward is tremendous when you look at this. And Bob, I can't even do it with a straight face. I was trying to like prep the next slide, but I'm just gonna go and title it. So you need potatoes to make chips.
You came up with this title, and it's
I
a
did
good one.
not.
Okay. Well, we're just going to say you did. So you need potatoes to make chips. And by chips, we're talking about semiconductors. And by potatoes, well, it's all the rare earth minerals, metals, and various things needed to make semiconductor chips. So, you hear about the importance of semiconductors. They exist in just about everything we use, from cars to phones to microwaves to smartwatches to the microphones we're using, the light that we have, so on and so forth, our TVs, pretty soon our brains. We are making fewer semiconductors.
We as in the US.
Yeah.
Yeah.
So you hear this talk about, we need to restart production and we need to grow our production. Yeah, it's going to take a long time. If you look at this list on the left of countries and their share of production, the only one that's growing their share is China. So I don't know how poorly we can treat China, especially if we need various chips.
We have to have some type of dialogue with them.
And we don't make that many.
Yeah.
So we are forced to be friends with everybody on this list because, well, we use more of them generally than anybody, and we need them. Not to mention on the right side, the potato chart. We don't make a lot of potatoes, and by potatoes, we don't have a lot of rare earth minerals. That is owned by China. We certainly don't produce any lithium for regulatory reasons, but everyone else does. There's not a ton of copper that we produce. We have enough zinc, very little nickel, and almost no cobalt. So if we're going to make chips, we need to be friends with some enemies, and we need to be friendlier with some of our friends. Otherwise, we won't be producing much more of anything. So choose your enemies wisely here.
Yeah.
And we need to be very careful with policy shifts and what we say and who we say it to and all that fun stuff. Otherwise, we'll be short on materials unless we radically change policies for unearthing various things that have been protected over a long period of time. So just be mindful of that. You do need potatoes to make chips. And without potatoes, we have no chips. So we just need to then make friends.
Well, let's talk about policy change. It's election time.
You brought it up, not me. But anyways, I'll go with
I
it.
did not.
So 2024 election, it's anyone's guess. So go to polymarket.com, search for yourself the projected outcome. This is based on the betting markets. Yes, people bet on this stuff.
And this is as of yesterday.
This is as of
September
yesterday,
5th.
yeah. So this is today is September 6th. It is about 10:34 a.m. This is as of yesterday. We didn't check it today. But here's the breakdown. It's kind of a push. Again, it comes down to the key swing states, and you see a few unknowns, a few shaded lightly red, a few shaded lightly blue. That can shift. If you check it daily, it does change daily. I have seen a bit of a shift. We were talking about this, Julina. Both were at 48, 49 for a little while. It was really the past 7 days, and I think the shift has come from the wildly changing tax policy.
Yes.
We heard about 44% capital gains rate, and we heard pushback. Then it was 33% capital gains. Now it's 28% capital gains. Then it was a $3.5 million exemption on the estate tax with a 65% tax rate above that. Then it's a wealth tax. There's a lot going on, and I think that uncertainty has shifted some betting in favor of Trump. So that's my take. But anyways, next month we'll show you this, and who knows, it might be inverted. But
Yeah.
it's going to be close, and again, it's going to come down to a handful of states.
Yeah. How quickly this shifted over the last matter of months. And we talk about this all the time. Elections create emotion. Emotions can create volatility in the markets. And there's an interesting trend here.
Yeah, this is the measurement of volatility in the market. So the VIX index, that ridiculous index that measures the volatility, it shows you when you just look at the historical level of the volatility index, you see this around election period of increased volatility.
Mhm.
Why? Hype, mania, advertisements, you know, brainwashing, all that fun stuff. All the commercials telling you how bad everybody is.
Yeah.
There isn't a commercial that comes out politically that connects both sides together. So what does that do? It creates a negative vibe, and that negative vibe is played out through the markets, and then it goes away,
Yeah.
and then it just poof magically goes away.
Another poof.
Yeah,
And this slide is very similar to the one that we kicked off with, but now we're just talking about, and now we're talking about the two different parties.
yeah. For those who think it really matters, it really doesn't. The aggregate lines measured, you have an incumbent party won, an incumbent party lost. It was broken out a slightly different way, and the direction of the market for that year, and then after election day.
Yeah.
Again, it doesn't matter. It matters until election day. Then election day, the direction is just about the same, upward arcing. So it doesn't matter really who wins. It's upward arcing. Really, what do the markets want? The markets want to know the rule book. Businesses want to know the new rule book, and then they'll adjust around it. That's about it, right? So the markets move higher historically, um, but not until election day.
Yep. And the next title is very cute, and I'm a big fan of Ted Lasso, so I'm going with it. But be a goldfish.
Yeah, the great Ted Lasso telling a struggling player who was just having, some mental issues for a short period of time was impacting his performance. He said, "Hey, just be a goldfish." The point there, and I know this is like a myth, but the point there is goldfish, their short-term memory gets erased every 10 seconds or so, right? So shake it off. And as an investor, to be a successful investor, you have to be a goldfish. You have to let all these negative headlines and positive headlines just kind of roll off. Forget about them.
Mhm.
Focus on the fundamentals and focus on what's important to you and focus on having a strategy. But you really need to be a goldfish. You need to be able to weather a storm. Storms happen all the time, both in life and in the markets. And if you can be a goldfish and shake everything off and focus on the future, you too will have lots of success. So remember that because you're going to have to be a goldfish often over the next 60 days or so.
Yeah. And and I think that this slide very well represents the recent volatility just last month and how quickly the markets turned in their opinion.
Very good point. Yeah. So the first week of August, we had this horrible Monday, and the world was ending, and CNBC was doing a great job of telling you that. And then by Friday, the market was not down.
Yeah.
So just within
It was
five
bad.
5 days,
Yeah.
nothing happened.
Yes.
Anyways,
Yep. That's a great point. And I think we're going to end with just a great reminder about how important diversification is through
yeah,
the investment process.
yeah. Regardless of what's on the horizon, diversification in a balanced portfolio wins out, right? And what do we mean by that? Well, whether it's 60/40, 50/50, anything in between, maybe up to 70/30, having a combination of large cap stocks, some small cap, some mid cap, some dividend payers, some growth stocks, a little bit of international, some fixed income. When you mix it all together in a pot, that recipe is success. It tends to be very good often. Rarely do you see it not work. And this chart illustrates it beautifully for you.
Mhm.
So if you have a diversified portfolio, you have a strategy. And if you're working with us, you have both. You really don't have to worry about this stuff. And it may be a hobby and it may be fun. But really, if you're working with a competent party, we've done a good job of understanding who you are, what your strategy is, what your goals are, what your needs are, and all that fun stuff. You're going to do well. and we're going to work very hard for you to make sure you do well. Worry a little bit less because the odds are definitely in your favor. This isn't a casino. These are good fundamental investments. If it's equities in companies that have earnings, market share, good management. If it's fixed income, oftentimes it's very high quality fixed income with good yields, oftentimes above market yields. And the combination together means a lot of success for you, your family, and the coming generations. So whether you're worried about the election, I guess I would say it this way: the outcome is clear. Half of the country will be upset with the outcome, and the other half will be very happy. Um, and actually, there is another outcome, the inverse of that. Whoever, whoever you are, whatever side you're on,
Mhm.
there's someone that's going to be unhappy. There's someone that's going to be happy. It's just what period of time is it? What party wins? Who's going to be unhappy? Who's going to be happy? And then it swaps over time, right? Hopefully someday we'll get back to a scenario where we have candidates that represent the 95% of people that lean somewhere near the middle.
Mhm.
But there's no fun in that, right? Hopefully someday. And I always like to say, after a hurricane comes the good weather. When you reach extremes, when you have extreme discounts in the market, creates an opportunity. When you have extremes and it feels like the candidates can't get any worse, that usually creates a scenario where the demand for better candidates who talk about issues with real solutions sometimes appears. I believe that will be the case. We might just have to wait a little bit longer. How
Yeah.
about that?
Yeah, and as always, we're going to have another monthly webinar next month. So as we really approach the election, we will make sure to readdress the issues that are at hand. But certainly in the meantime, if anyone has any questions or concerns, please know you can reach out to any of us at Principal Wealth. We're here, and we want to make you as comfortable in this process as we can.
That's right. And remember to be a goldfish, but don't forget the stuff that we just talked about.
Yeah, I was going to say that, but good.
Great.
Thank you, Bob, for the insight as always, and look forward to reconvening next month.
Yeah. See you next month.